All right, perfect. Let me get over here where it makes it bigger. There we go. All right. So here's your wonderful disclaimer that we all, or agenda disclaimer that we always have to have. And then let's jump into some stuff. So first of all, for investment planning, I always like to do this in three parts. How are we going to help you with your investments? What is a financial planning idea? And then let's interview somebody who's from the professional network and can do a better job than we do. So if you look at this, what you will find is in election years, most of the time the market is pretty weak for the first two quarters and then fairly strong in quarter three and quarter four. And what you can also see here is why this might be a little bit weaker, but not necessarily negative. And that doesn't mean that's the future, that's just the history. And please interrupt me if y'all have any questions. But one of the other things I would love to say is if you look at inflation, look at the spikes we had back in the 70s and early 80s. And then where we were now, which was very painful for a lot of people, but it has come down. Everything, and I'm just saying from personal experience, everything except groceries doesn't seem to keep going up. And that's what you're seeing, but that also is a nice catalyst for the stock market. If you look at producer price inflation and the difference between these two, when you look over here, and it is, all right, try to move back. This is what you're actually paying. When you go to consumer prices or producer prices, this is what you will pay if you are a producer making goods that will be sold in the future. So it is, still trending down, and that is a good sign for future inflation. Also, check out this job chart, and I'd love to pause and see if y'all have questions here. Look at how much it has gone up as far as what's available and total jobs being created. And at this point, that is actually a stressor for businesses versus a catalyst for businesses. Any questions or thoughts on that? Okay. And then on that same note, we have basically, if we're running real GDP, CPI, and unemployment, and the bank rates, we're in a very good position for a very nice 2024. And if you look at this expectation, it puts us right in line with a GDP growth and some inflation that is not negative for the economy, which makes it a very nice investable environment. So here's our thesis, and I want to say this, and I'm moving quicker than normal because I want to move over to D very soon. Monetary policy remains relatively tight into 2024. Fed has shifted towards a dovish tone, but the path remains unclear, and that's great. I love the Fed where they are right now. They are basically saying we're looking at immediate data and we're not going to make reactions unless it fits in with that. A soft landing is beginning to look likely, which no one, or not no one, but a lot of people did not think was possible earlier in this year or last year, and they also didn't think it was possible before that, but they've done a great job navigating that. And I think this is an interesting one that has really been kind of clouding over us for the last 2 years. Geopolitical risks seem present but appear contained, meaning we don't see those geopolitical risks actually going in to impact the market or your portfolio. Any questions? Okay. And then this is very important. And we really have to remember what is going on here, which is asset classes, because so many people have been wondering, why are we still investing in international? Why are we doing that? There's certainly capital market theory, which says you need to equally weight across the world because businesses are smart. However, it hasn't really proven true. If you look at the last, 40 to 50 years, what you really find out is the U.S. has done a lot better than other parts of the world. But what I would say is if you look at the investment landscape and you look at their price to earnings ratios, they're actually a lot cheaper overseas than they are here. And so that is the main reason why we want to make sure we have some exposure to international as well as emerging markets. And these are the forecasts from JP Morgan, Vanguard, and then the average 10-year assumptions. And if you look at this, you see that almost everybody on a future outlook outweighs the US. Has not been the case in the rear view mirror at all, but I get it because you got to think about not necessarily who's going to succeed more, but who's going to grow faster. That's what we're looking for. Who's going to grow? And so when you look at it, we might stay the same, but they might grow. And then also the price to earnings. One thing I wanted to say about this is that it is not astronomically high, but it's higher than it was. And one of the main reasons for that is the Magnificent Seven, which is 7 stocks that are accounting for about 40 to 45% of the S&P 500, depending on when you look at it. It's Facebook, Google, Apple, Nvidia, a couple others, Tesla, and 2 others that you know off the top of your head. At this point in time, we have a 19.3 earnings percentage, but it is a lot lower if you take those out, which basically means it's still a very well diversified index, as well as money managers can move money towards stocks that are still undervalued. All right, so I will pause from that. Do you guys have any questions?
It's been frightening that the like lunch around here is $25, $35, and I'm starting to bring my food. And a lot of other people are. How it just seems like inflation's gone nuts. I know we saw the graph where it's going down, but hell, I'm bringing oatmeal in the morning and a yogurt for later. I've never done that before in my life because if I pay $25, $35 for lunch and then still have to pay for dinner, no way I could retire on that. It'd take my paycheck. It's like a car payment or a mortgage.
Yeah. And unfortunately, it's on the things that are like the goods that we have to buy on a daily basis on stuff, where we're seeing the most impact.
There's a fried rice place. I was going to get some fried rice. It was $31.
Yeah. Well, I mean, that's where the inflation is. And you got to understand that they're calculating in everything. And there's a lot of areas where there is deflation. For example, computers and TVs and clothing, quite frankly. But yeah, I totally get you, Robert. Totally.
So you have to wait for it to settle down to feel more comfortable for a big move like retirement then, really, right?
All right. I have a couple of comebacks on that, and then we'll get into the planning, and then we'll turn it over to Dee. But I would say the problem with that statement is that when you retire, you don't know what's going to happen in 10 to 20 years. But you're going to need to be retired in a situation that you can stay in for the next 30 to 40 years. So because you don't know that, you need to have something that's kind of like hedged and available to get you away from, what is the current economic environment and what is the current inflation rate.
Yeah, I needed to know this 40 years ago.
And I don't disagree with that.
Yeah. It's
anything else?
Everything that goes up eventually will come down. It's, it's a cycle. It's a cycle.
Perfect.
Unfortunately, it's a painful one right now.
All right, let's jump back in here. All right, I have a quick advanced planning idea, and then we're going to move over to Dee, who has a lot to say about the current insurance market, which also kind of relates to inflation. First of all, right, it's more of a lifestyle thing. It has nothing to do with y'all's money or your account or anything that you're actually, thinking about as far as investments or financial planning. But, what do you do for your money? Because when you think about your money, what you're really thinking about is, how does this get used to make me happier? Or how does this get used to better causes I care about? Or how does this get used to better people I care about? And so, I found this article that I thought was really interesting to share with you guys. It's about glamping. I mean, basically, the idea of I have enough money to go and pay for a nice resort, but at the same time, I want to experience the outdoors. And I will tell you that most of us, if you think about the last 2 to 3 years, I mean, it's been hard for the world. It's been hard for a lot of people's mental health. It's been hard for a lot of other things. But what we need to do is relax. And a lot of us, especially our clients, really love to relax with their grandkids. So what we're trying to do with this article and this idea is just suggest some ways you can do that. So if you think about it, let's make it comfortable. Let's also make it available, and let's also make it something where we can commune with nature. It's a really nice idea, and I assume most of y'all have read this. So I'm going to change, but if you think about it, there's a lot of options. There are a lot of places to go. There are a lot of things to do, and I just highly recommend we all pay attention to that part of our life as much as we pay attention to the balance sheet.
Yeah, agree 100%.
Cool. And then I just put this on here, and Juliana kind of laughed when I sent this to her, but got it. Because I've been thinking this for the last 10 years, and it finally vindicated me, which is childcare costs more than college. And that's actually true. And the reason I'm showing this to you guys for an advanced planning topic is so many of our clients say, how do I help my grandkids go to college? And the truth is, that's not really that hard. The only reason our industry makes that a big issue is that's how they can make money. And if you ever want to figure out an evil, side to our industry, it is college planning. What is really hard is actually sending your kids to daycare. And so this talks about the idea of how to help either your grandkids or children get through college, which is truly, or not college, but just childcare. It's truly more expensive. So the thought of paying for a kid's child education is a huge financial stressor for most parents. But the burden of raising kids starts well before that and well before they're old enough. And think about this, and this is a great investment planning idea for you guys. Compound interest is incredibly powerful. Incredibly. So I looked at my kid's 529 yesterday after talking to a client that wanted to do something for his kids that are going through private school. And I logged in, hadn't been in there in a while, and contributed a little money because of his inspiration. And what I saw, the numbers just surprised the heck out of me. I had no idea how high they would be, and it's because of compound interest. So just realize that when you have 18 years to plan for something, you can do that. When you have 9 to 12 months to plan for something, you really can't. And that's the difference here. So anyway, wanted to show that to you guys, and then I will pause for questions.
I could have used that advice 23 years ago with twins. Where were you back then?
I know.
That had to have been pretty amazing back then. That was a mortgage payment for two at the same time.
Well, and that's amazing. That was 23 years ago.
Oh yeah,
I mean, I told the same thing in 2012.
yeah, it's crazy, crazy. So yeah, that's a really good mood and definitely something that will help parents save for kids' college when they don't have to worry about the stress of childcare while they're trying to grow them into
Correct.
adulthood.
Absolutely correct. All right. And so now I would like to turn it over to our wonderful friend Dee and just talk a little bit about the insurance market and some other stuff that's going on there. So, Dee, you mentioned when we talked before how tough the market is today. Tell us a little bit about that.
Well, thank you, David, for having me here today, and thank you guys for staying here. Today, I'm just going to give you a little bit about the current state of insurance affairs in the industry. You probably, as long with everything else that is going up, had been receiving your renewal policies. In the state of Georgia, over the past year and a half, the insurance rates have rose just over 20%. And unfortunately, we're not seeing a lot of relief in sight. If you guys have noticed, I've seen it a lot in social media lately where everybody's looking or complaining about the insurance rates. Well, a lot of has to do with inflation, number one. That's one of the biggest things, along with food going up, is insurance. One of the biggest reasons is the number of accidents has increased, particularly in the state of Georgia. I was telling Dave the other day that Georgia has changed substantially. Georgia used to be rated in two different ways. We had the rural part of Georgia where there was not that much traffic, and now you have the metro area that was, the closer that you were to downtown, the higher your rates were going to be. Well, that's not the case anymore. Unfortunately, there's a lot of people driving distracted, which is causing a lot of more accidents that are a lot more expensive than before. You have the fact that the cost for labor is more expensive. There is not that many parts, and there's a lot of litigation. People are getting hurt. First they do is they call a lawyer to file, a larger claim. So based on those reasons, that's what we're having this biggest impact on auto insurance. Same thing for homeowners. For a while, we saw a lot of claims, roof claims. You guys remember, there's nothing more that we can do about the weather, but there was a lot of claims being paid on a regular basis. So again, with the cost of labor and the cost of materials, insurance companies, as much as they want to say that they want to help, they are not for profit. They need to make profit. And they have been losing a lot of money in the state of Georgia. So that is part of the things that we are not going to be able to see, unfortunately, reliefs. But there is ways where we can maximize our insurance dollars. And a good way to do it is always call your insurance agent. If you have an independent agent, call them and ask him for a review of your coverage. Sometimes he just takes a review to be able to update your coverage, find out what's going on and what state in life you are. That might be able you need insurance for it, or you might not need insurance for it. The coverage review should be done annually, and your agent can tell you if increasing your deductibles can save you some money, or deleting comp and collision coverage, which is the physical coverage on an older vehicle. Little things like that. You also want to call and ask to see if you qualify for additional discounts. There are so many discounts that sometimes they don't get applied, and they have it for defensive driving. Sometimes if you take a defensive driving class online, it will qualify you for an additional 15% per driver. So that's a good way to make sure that you have, all the credits that you have, like multi-policy discount. If you have your policies separated, when one company won and the other, you're leaving money on the table. In the past, it used to be like 5 or 10% discounts. Now it's more like in the hundreds, $500 to $300 to $600, depending on the company. So make sure that when you're calling for that annual review, next time that you receive your renewal, you said, hey, what kind of discounts I can check for to qualify. Younger drivers, if you happen to have kids that are still in college, but they don't have the vehicle with them, that's a huge discount. And
Yeah.
most times it's not something that comes up during the conversation unless you ask for it. Another thing
Let
that
me ask you this. You had
uh
mentioned the other day when we talked about the deductible.
yes.
How does that work kind of, in a linear fashion about raising your deductible and lowering your premiums? Because I love the idea of people, maybe paying more out of pocket, but less in liability.
Well, and here's the thing, because right now it's a very hard market. Insurance companies are looking for reasons not to insure people anymore. They're kind of scared. So the best thing to do is protect your insurability. And how do you do that? Is by not filing smaller claims. So the best thing to do is you increase your deductibles, knowing that you're gonna kind of like self-insure in the event of you have a claim that is less than, I wouldn't even recommend filing anything less than $2,500. You don't want to use your insurance policy as a savings account. You want to use it for the catastrophic type of events, for the big things. And what do you do? By knowing that you're not going to be filing the smallest claims, you increase your deductible to an amount that you feel comfortable with in the event of a loss and put that money back into your pocket. Give it back to David and put it back to work for the future. That is the best way to self-insure, protect your future insurability, and make sure that that money goes back to you instead of the insurance company. That's a great question.
You mentioned something the other day about kind of cookie cutter versus specific insurance, and how people, might outgrow a certain carrier, but at the same time, you have to debate that versus lifetime insurability. So how would you balance that?
Well, you want to make sure that you get your insurance coverage review once a year is good. Remarket your insurance because insurance companies file rates up and down on a regular basis. So the best thing to do, make sure that you're paying a fair price, is just having a review, taking that out to market at least every 3 to 4 years. The way that your life changes, your insurance grows with you and changes as you grow. In this particular stage in life, when you were about to retire or you're already retired, you may say, you know what, I'm just going to sell my house, get that money, I'm going to start traveling all over the place and buy a RV, which I have a lot of clients that are actually doing that. And that is a fun way to put money back in your pocket, but you also want to make sure that you have the right protection. And that would be in the sense of having excess liability and make sure that the new policy for the RV will have the liability cover between one policy and the other, and make sure you have, personal protection coverage on your personal property. So when you decide to make those changes in life, it's a great time to call your insurance agency. Your current company might be the perfect for where you were 5 years ago, but it might not be the perfect company for where you want to go from here for the next 10 or 15 years. So having a review and making sure that your company is still meeting your current insurance needs, it's the best way to, again, protect your insurability, as well as making sure that you're not giving them extra money that you don't want to give.
Yeah. So one thing you mentioned there is the RV, and then, some places take this back to, but we have a lot of clients that want to do that. Is an RV homeowners? Is it auto? Like, where does that fall?
There's always a fine line. It all depends. If it has tires and you're gonna be moving from state to state, that would be more like a recreational type of policy that will give you both auto liability while you're driving, but it also gives you liability coverage for in case you happen to cause damage when you're parked, and it protects your personal, not only the RV itself, but any personal property like clothes, furniture, anything that might be inside of it. So there's products like that. You just want to make sure that you don't buy a regular auto policy for the RV because all of a sudden it leaves additional things that need to be covered that I will not be covered on the homeowner's policy anymore.
Cool.
So I just Googled the profits of the CEOs on the insurance industry.
Yes.
Says
Oh
that
my
the
goodness,
top 10.
Robert.
Oh, I would be the one to do that. The largest 10 personal insurance companies earned 130.6 million in
Yeah.
the latest fiscal year, and that's up from 123 million in 2021. So it just, that their definition of profitable, losing money is makes me skeptical, because I heard that the inflation is mainly due to large corporations price gouging, and then they're claiming that their costs go up, but then the next year they're bragging about profits. I know that's not practical to help us now, and I appreciate you telling us how to lower our insurance, because I'm paying like $260 a month with my new car, and it's, I got to get the test, the driver
The
safety
defensive
thing.
drive. Yes.
Yeah, and carry that little thing that slaps you if you go. You can only go like 6 miles over the speed limit, and everybody else is honking at you. But if it gets me 10% off, I'll do it.
I agree with you. I mean, it's one of those things that, yes, have issues. But Google the amount of losses paid in the state of Georgia, and that should give you an idea of where this is coming from. Because I'm lucky enough to see both sides, and I'm a consumer just like you are, with 3 young drivers, which is
You're right.
killing me.
I Googled Georgia, but the thing I clicked on did not
Well,
say Georgia.
Yeah.
And I will also
Yeah.
say, and Dee, correct me if I'm wrong, but the pure logic behind insurance is
Mhm.
basically the true cost of insurance should basically be equal to the amount of claims paid out or a little bit extra in reserves, just a little bit. Anything over that, and this is, Robert, just so you know where the profits come from, it is really about the administrative
Reinvestment.
fees and the writing fees and a couple of other things. So,
Yes.
the cost of insurance is pretty pure. That other stuff is where the dirty work is.
Yeah. And what they're doing is they're reinvesting premiums. So where does the profits come from? But if you compare the profits versus the losses paid, it's very close to each other. I mean, it's to the point where it's a very hard market. I don't know if you're familiar with insurance in the state of Florida, where they have to go through a pool to be able to get insurance. Georgia is getting close to. We don't want it to get to that point. They are looking to get more rate increase, and you're like, how are they going to do rate increase if we just went through another rate increase last year? But cannot keep up with the amount of litigation paid on every single loss. You have even accidents like bumpers. Yeah, I was talking to David the other day. Now, vehicles in the past, when I started in insurance, bumpers were like $300-$400, and they're
Now
made
they're
to bump
thousands.
into another vehicle.
Yeah.
Exactly. And it's the technology that the vehicles have. You have a lot of, 3 or 4 different cameras in a bumper. So a bumper that gets damaged, you're looking at $4,000-$5,000 for a bumper that was meant to bump versus to back out with the camera. And that's where we are paying the most claims out, and that's where we're paying more for
Yeah, I'm
insurance
sure
premiums.
they justified it, but they're still coming out very profitable.
Oh, yeah.
That if somebody really actually checked it. I went on vacation to the Netherlands last month, and the drivers were very different than they are here.
Okay.
Here in Georgia, they're very aggressive.
Aggressive.
And I don't,
Yes.
it's not all being distracted with the cell phone.
It's
Very
very
aggressive.
aggressive driving. I don't like driving as much as I used to anymore. Just for the, I'm like that too. Just going to the store less than 3 miles, and you're like screaming at people for doing the wrong thing, and coming at fast or passing you on a 2-lane road.
I'm trying to learn how to drive defensively, and the aggressive ones don't necessarily want to pass you either. They want to attack you from behind.
Yeah, driving is not as fun as I used to. I loved it before, and now I'm like, no, don't like driving that much anymore. Anybody else can drive. I'm okay being a passenger.
Yeah, I agree with that. And I see your point there. It's certainly the administrative fees and other things can come down, but you got to remember they're providing a great service to this country and to the world. And they do have to get paid for that. And I would question, and I've looked at this, whether a CEO from an insurance company is outpaid versus a CEO, from AT&T, or a CEO from Google, or a CEO from Facebook. And it's in line.
I shouldn't have said anything because the link I picked was national. It wasn't for Georgia. So
Yeah.
And
No, it's all right.
It doesn't indicate the corporate profit, which is what I was really looking for. But I don't know how to use Google because I can never find what I want.
Well, I will say this, and this is what is great about insurance, and you want this to be true.
Mhm.
They have a formula where they will always be profitable. And if
Mhm.
that didn't work, they would not be able to pay your claims. And so you got to keep that in mind.
Yeah. It's never going to put you in a better place. It's not going to put you below where you were. It's going to put you where you were before. And again, it's designed to be a financial tool that will protect you and and your money in the event of a catastrophic type of event. It's not designed to be a savings account every time that something little happens. You have, the towing claims, the, you know, windshield, cracks, the service, you're better off getting a AAA membership than using your insurance, because those little claims, those are the things that are going to stop you from getting to the best and the for pricing. You
Yeah.
need to protect your insurance, your insurability, the same way that you protect your credit. When you have a great credit, you qualify for better rates, better pricing. Same thing with insurance. You protect your insurability because that way you will be able to save money on the long run and use it only as it's needed, not every time that something happens.
And Dee, I'll ask something that I thought was great about what you said. You have great credit. So a lot of people don't understand like credit scores impact your insurability or your price. I totally get it, because your credit score impacts your ability to pay an out-of-pocket expense, whether it be your deductible on homeowners, which, the higher it gets, the lower your premium is, your deductible on auto, same thing. And so can you elaborate on that?
Yes, because its insurance score is a little bit different than credit scores. And when we are, insurance companies, you're qualifying for a new policy, we don't get to see any of your credit. It's a snapshot of your insurance history, which includes amount of paid claim in the past. It also includes your payment history to the insurance company. If you have cancellations every other month, that counts against you and it lowers your insurance score, which makes you stop from qualifying from best pricing. In the past, we used to have 3 standard pricing, which it was preferred, standard, and non-standard. Now insurance companies have between 75 and 150 pricing levels. So what you do is kind of like climbing a ladder. The higher that you get on the ladder, the best pricing you're going to get. And protecting that insurance score, making sure that your bills are getting paid every month on time, that you don't file a lot of claims, that you don't jump every 6 months from one company to another, is going to have an impact on how far you get to the top of the ladder. So yes, insurance score is as important as your credit score. You don't get to see it, you don't get to order it, but you know that you're a responsible person when you use your insurance company the way that it was meant to be, which is for the catastrophic events.
Yeah, we always hear shop your insurance and check your quotes, but you said not jumping from one company to another. So let's talk a little bit more about like what's important about being consistent and staying with the same company.
Okay, insurance companies like when you have stability. Okay, so usually being with the same company 3 to 4 or 5 years helps you qualify the next time that you move to a new company to move to the best preferred ratings. However, if you're switching your coverage every renewal to a different company, it shortens the amount of stability with the same company, and it actually has a negative impact on being able to qualify for the best pricing. It's one of those things that statistically it makes sense for them, because they want somebody that is going to be a ideal policyholder, it costs money to issue your coverage. There is the clerical part of aspect of it. So the more that you switch around, the most it costs them. If you stay at least 3 years with the same company, which is usually the best time to show for your insurance, or if any major changes happen. They file rates in certain zip codes. Some zip codes are more competitive than others. So if you're moving to a new location, a new state, that is the perfect time to shop for your insurance. Don't wait 3 years. However, you're staying in place, nothing has changed. It's been 3 years. You know what? Let's check them out. Make sure that they still have a fair pricing, because that's exactly what you want to do. You don't want to pay cheap insurance. Cheap insurance can be very expensive. You want to pay a fair price for the risk you are. And if you're a preferred risk, you're going to prefer price rise, prefer pricing.
I mean, I got a great question for you on that. Seeing some people that are on the call. So you talked about moving from one state to another and that shopping. What about when people buy new assets? For example, a lake house or, new car. Is that a good time to shop, or, what should they do at that point?
It depends. It depends. Sometimes when you're buying a vehicle, let's say I have a lot of clients that they like the same type of vehicle, right? They have a truck and they decide to get a newer truck. That is not going to have a major impact on the premium. They're probably going to charge from just an older vehicle to a newer model, and that's going to be your pricing difference. But let's say that you decide to buy a Ferrari. That is, you decided that, I'm going to treat myself and I'm going to get a Ferrari. Well, that's going to be a lot more expensive vehicle. And that vehicle most likely is not going to qualify for the cookie cutter type of insurance company that we were talking about. So that is the best time to shop for the insurance, because you're going to go for somebody that specializes in the type of coverage for that type of vehicle. So it really depends on the type of change that you're making in life. Would it make sense to go ahead, take everything out to market? Or no, you know what? This is just a single change on the policy that is not going to have a major impact on my premium based on me as a preferred driver at a certain age. It's kind of interesting because you can have the same vehicle for a 40-year-old and the same vehicle for a teenager, and the teenager and the same vehicle is going to be 3 times more expensive. And it's just because it's the risk.
So, I got a question when you get it.
Sure.
Yeah, go ahead.
So bought a new car, a Toyota Highlander.
Mm-hmm.
And my rent-a-car was costing me $2,400 a month, so I had to pay pandemic prices, so $57.5K.
Wow.
So now that my insurance is like $270. There's two questions bundled into one. I feel like I can't shop around because State Farm's giving me a discount because it's bundled with my home insurance.
Mm-hmm.
But I'm paying like $270, and they hint if I take the class and carry the drive safe thing, I might get it down to $230 or something like that. I don't know if that's a good rate, but I feel kind of like I could always find insurance cheaper somewhere else. And then
Mm-hmm.
a year later, they're going to raise the prices to where it's not really cheaper, because State Farm always does that to me. Every time I call and say, hey, why am I paying $200-300? They'll give me a big break. And then a year later, they keep raising it
It goes
$7
away.
here, $10 here. It's gone in 6 months or a year. It's just like
Well,
you're dealing with a casino.
Well, and I'm sure that in this area, Dee's going to, jump to lifetime insurability, but that's an issue here too, because I've never seen, based on what we talked about earlier on the pricing, I've never seen one carrier go up when others don't, unless they just leave the market. Is
Right.
that wrong?
So even if I change, I could get it cheaper somewhere else, but then they'll end up raising my prices over the next 6 months, 6 to 12 months.
No,
I
there's a
think
lot of value in lifetime insurability too.
Yes.
And you also have to look at the price of your total bundle. It's like, I went to State Farm, and that's because once you added the homeowner's liability, the car insurance all together, I was paying more for parts of it and less for other parts of it. But in total, it was cheaper than the other companies
Right.
quoted me
You're
in
looking
total.
everything as a package, a whole package amount. And that is something that I use on a regular basis. Sometimes you're not gonna be able to get both of them in line lower, but at the end of the day, when you see everything as a package for the annual cost, it's gonna be much lower than somebody else. And again, Robert, it has to do a little bit of, everything. If you have a single car, single driver type of policy, your rates are going to tend to be more, fluctuate a little bit more depending on what insurance companies.
Damn, so I got to get married.
Yeah, that's that's one of those things that they give you as a present, the marriage discount.
There you go. Isn't it nice to actually have a discount for that?
Yes, it's one of the very good things that insurance does when you get married. Your pricing goes from here to here.
So then I won't be an aggressive driver.
Unfortunately, at this point are kind of even depending on
Yes.
where you are with that, but other stuff, that's nice.
Yeah. And, I'm like doing the math here, just based on the amount that you said. And let's see, you said 260?
260, 270, yeah.
Okay, so you're paying about $1,500. I'm assuming that, you have full coverage on the vehicle because you said it's new, it's probably been financed.
I could have paid it off, but I needed to have some, I don't know why. I wanted to save money because I need to do work on the house. So I financed $10,000. So I'll probably get rid of the liability. I mean the full coverage in a couple of years once I get used to the car.
Yeah, and it's one of those things, if the car is parked at home and, you don't have to have the compound collision, just like we said, there's a lot more aggressive drivers out there. It doesn't have to be you, the one that is not driving safely, but it might be somebody else, screwing up the car.
Well, but they always like to say that both parties are at fault. So, I'd hate to have to get lawyers involved.
That's one of the things that you have to decide if it's worth taking the compound collision off, if it's fairly new, just because the used car market is a lot higher than what it used to be in the past.
Right. I have one accident every 10 years.
Yeah.
So
that might be changing in the future, a couple of years where, used car prices go back to where they are and lose the depreciation, and it's a little bit more where the pricing goes down.
Oh, but hell, yeah. I want my car to stay valuable. Now that I bought a new one.
Me too.
All right,
Just
you guys
kidding.
are funny, and I'm glad y'all have had some nice back and forth here. So I'm going to sum this up because we're about to come up on time. We're coming up on 12:50 here. Dee, thank you so much for the input. Obviously, it relates to a lot of folks. Guys, reach out to her. She's at DM Insurance, and anybody, and Dee, you're welcome to send us a link to your webpage, and then we'll go ahead and forward that to anyone who's on this and some other stuff. But anybody who wants to shop it, what I love about Dee is she's honest.
Thank you.
I sleep at night. Yeah, she sleeps at night. She's honest. She'll tell you if you should work with her or not, and she'll review it and give you a good situation. And I will say the same thing about investments, because everything we said about inflation earlier and about the economy and the great growth, that's, it's rear view mirror. We have to still look to the future and make our best predictions. But guys, what I can tell you is America grows, the world economy grows, and we're all going to be okay if we invest in the idea that the future can be better than the past. So thank you so much, Dee.
Thank you, David.
Thank you so much, Juliana, for putting this together. Joe and Robert, great to see you guys on here. Other folks that haven't shared your camera, that's fine too, but look forward to seeing you guys, and let us help you in a more one-on-one basis if that is something you need. So even the most successful people, and I say this at the end of every webinar, have things they sometimes regret financially, and what we want to do is help you to minimize those.